What's up, everybody? One of the larger holdings in my portfolio, StoneCo, ticker symbol STNE, reported earnings last week. We're going to take a look at it. It was a pretty good earnings report. This company is still growing double digits, buying back an absolutely massive amount of stock. StoneCo is up close to 100% year to date. Since this earnings report, which the market liked, the stock's up, about 16%. But even at today's prices, the stock is still trading for less than 8 times next year's earnings. I think it still looks cheap. I think the risk reward still looks quite good. There's a few things in this report that I thought were a little bit concerning that I want to keep my eyes on. So we'll talk about that. We'll talk about some of the risks. And as always, if you get value out of the video, subscribe to the channel. I absolutely cannot believe that we have passed 2,000 subscribers. So thank you so much to everyone who has followed. Now let's dive into StoneCo. First, if you haven't seen my previous video on StoneCo, or you have, but it was a while ago, I just want to go over what does this company do? How does this company make money? This may not be a company that a lot of investors are familiar with. It is basically like the Square or Block of Brazil. It is a fintech company. It's a payments processor in Brazil. Their revenue has really taken off in the past decade. They've been a huge beneficiary of the transition in Brazil from, mostly a cash-based economy to nowadays where the vast majority of transactions are digital. So they process payments with these little point of sale terminals that merchants can have. It made it very easy for small businesses to accept, credit cards or whatever form of payments. They're really targeting small and medium businesses. Those are StoneCo's main customers. Nowadays, they've evolved from, just mainly being a payments processor to having significant banking and credit segments. So for that banking segment, that's people depositing money in StoneCo, essentially treating StoneCo almost like a checking account. This has grown a lot recently. Deposits have roughly doubled in the past couple years. 5 years ago, this was not a significant part of their business. And as far as the credit side is essentially lending out money to merchants. And then StoneCo, of course, collects interest on these loans. This is a segment that was insignificant a couple years ago. We see that their credit portfolio has more than doubled over the past year. This is a pretty profitable segment for them, but whenever loans are involved, there is of course an element of risk. But now let's get into the numbers for this quarter. Almost always when we're talking about the top line, we're talking about revenue. But for StoneCo, if they process, say, a credit card transaction and they have, a 3% take rate, maybe, it's not so useful to think of StoneCo's revenue as just, that 3% take rate that they're getting, because they might have to pay out of that certain financial expenses, like, a network fee if it's like a Visa card or a MasterCard. They probably have to pay an interchange fee of a couple percent to the bank that issued that credit card. So, at the end of the day, after all those expenses, there's going to be some gross net profit that's coming to StoneCo once they pay out all these other financial companies. So for StoneCo's top line, I'm still going to call this metric the top line. They're talking about adjusted gross profit, which is just their total revenue minus these direct transaction costs, these financial expenses. And they're guiding to grow the top line at 14% this year. Now they're saying 14.5% for the full 2025 fiscal year. And earnings per share, they've massively increased their guidance from previously they were saying 18% and earning, 8.6 reais for the year. Now saying earnings per share is going to grow 32% for this fiscal year, and they are going to have earnings greater than 9.6 reais. And in dollars, this is about $1.80. So $1.80 in earnings per share for the year, and the current stock price is, 15 and change. This is a company that today, even after the run up in price this year, they're trading at just 8.5 times this year's earnings while growing double digits. There aren't that many companies you can say this about. I'm always looking for companies that are trading for, single digit multiples with double digit growth. I don't find them too often. And when I do, I don't think that the growth is likely to continue, or there's something wrong with the company. They have a lot of debt. Maybe they don't return any capital to shareholders. And as far as returning capital to shareholders, we have to talk about their buybacks. A huge reason that they are increasing their guidance here for earnings per share is, yes, the earnings have gone up, but the shares have gone down a ton. They have a section on their website for buybacks. I'm pretty sure they added this in the past couple months because I don't remember seeing buybacks on their website before, but they have just bought back an absolutely massive amount of stock over the past year. Almost 10 million shares last July, almost 10 million shares last December when the stock price was down at $9 a share. They were buying heavily in the beginning of the year when the stock price was hovering around $10 a share. 5 million a month here, 4.5, almost 6 million a month here. As the stock has gone up a bit, they've slowed down their share purchases a little. But in the past year, they have reduced their share count by about 12.5%. They're down to 270 million shares. At the beginning of 2024, just, a little over a year and a half ago, this was about 320 million shares. They've bought back close to 50 million shares over the last 6 quarters. Last 12 months, they say they have bought back about $500 million in shares. Keep in mind, this is about a $4 billion company. So returning a ton of value to shareholders, that is great to see. Now, one change in the company that we should talk about, they sold off part of their software division. Lynx is a company StoneCo bought a couple years ago. They are software for small businesses. If you want to, manage your inventory, have like a nice dashboard for sales and analytics. That's what Lynx is. They don't consider this a core asset. And in fact, they've talked about selling this for quite a while. They definitely overpaid for this asset when they bought it a few years ago. They're not selling it today for what they bought it for. And, they took this as a loss a few quarters back. So Q4 of 2024, we see impairment of goodwill of, almost $600 million US. Writing down an asset doesn't affect, the cash coming in and out of your company. This is an accounting loss. But because they wrote this down, it looks like they lost an absolutely massive amount of money in Q4 of last year. And even if you look at the last 4 quarters, when you take this huge negative number into account, it looks like earnings have been negative over the past year. So because of this big write-down, you might see some places like, Google, they don't even list a price to earnings ratio, or some places might list a price to earnings ratio that is negative. But now they've reached an agreement to sell this software, so likely won't be on their books anymore, assuming this deal goes through, which it probably will, but it might take a few quarters for this to close, for this to finalize. Overall, I think that this is pretty good news for shareholders. This is an all-cash deal. And they talked a little bit about this on the earnings call. This bit of the company that they're selling, it accounts for 8% of their total revenue and only 5% of their net income, only 5% of their earnings. On the other hand, the value that they're getting out of this deal, which is mostly cash, and some of it is the fact that they're keeping this fiscal goodwill on their balance sheet so they can amortize out this goodwill, essentially taking it as an expense over time and, thus lower their taxes. In any case, the total value of all this to StoneCo is close to a quarter of their market cap. And again, this is only 5% of earnings. So just from a numbers perspective, this move makes a lot of sense. And by the way, that's why, in case anyone was confused on this slide, why it looks like, their updated guidance, adjusted gross profit is lower than it was previously, but they're still saying that it's growing, 14.5% year over year. Well, this is because now this guidance excludes the business that they're selling off. And as far as what they're going to do with the cash from this sale, they were asked about this on the call. One of the analysts said, hey, what's the plan here with Lynx? Is the plan to return this in capital to investors, meaning is your plan to buy back shares? And the CFO, Mateus, his response was basically, of course, there's still a long road until the deal close, but if we were to include the net asset value from discontinued operations, meaning if we were to include the cash from this sale, we would be sitting at close to 6 billion reais in excess capital as of today. This is a little over $1 billion US. Also, if anyone who's watching this is Brazilian and you want to correct my pronunciation, feel free. On the earnings call, when they say the name of the currency, it sounds like they say reais to me, even though it's spelled REAIS. But in any case, getting back to the CFO, he's saying they have a ton of excess capital. And he's saying we're going to be generating additional excess capital and also executing on the buyback we've already approved. In the absence of new opportunities available, the commitment and the idea is to return the capital back to shareholders. I like the CFO, by the way. When he talks, he makes a lot of sense. And I like the fact that they have been aggressive in buying back stock when it was cheap. There are so many cases of companies, especially like US tech companies, where when the stock is cheap, they're holding on to capital. And then when times are good and the stock's going up and earnings are great, they buy back shares at very expensive prices. Now, I think StoneCo still looks pretty cheap today, but certainly this time in here, beginning of this year, this was the time to really be aggressively buying back the stock. And that's a ton of the reason why you're seeing the EPS numbers look so good today. Shares have just dropped a ton, and I think this is likely to continue. Now, getting back to the results, revenue has grown 20% year over year. But again, I think a better measure here when we're thinking about top line is this gross profit, which is growing 14% year over year right now. So margins are coming down a bit, and that's because a lot of the growth is coming from low margin areas, especially in the payments segment. So when we look at payments and we're looking at total payment volume, where is the growth? Most of it is in this dark green, which is Pix. That's grown more than 50% year over year. And the light green, this is cards. That's only grown, about 6-ish% year over year. When someone pays with a credit card and StoneCo is processing that payment, they are getting a much greater margin of this share of these light green than they are for Pix transactions. Pix is a payment system that was developed by the Central Bank of Brazil, and it's been around for about 5 years now. It's kind of like Zelle or Venmo. You have these QR codes, and you can just scan the QR code at most merchants, at most locations, and pay for stuff. The central bank does not charge a fee for using Pix. If you're just an everyday person in Brazil and you want to use Pix for transactions, there is no fee for you. So Pix transaction volume has increased. And as far as the fees for the merchants, as far as what StoneCo is taking here, StoneCo does charge small businesses a tiny fee for processing Pix transactions, but it's very thin. This is very low margin. And for their larger customers, often they'll just throw in Pix transactions for free. So they'll say, if you have deposits with us, or if you have loans, if you're using our business in other ways, you know what? We won't take a processing fee on Pix transactions. We'll just throw it in as a benefit. So they're not making that much money on this dark green here. And even though total payment volume has grown 12% year over year, the fact that card volume has only grown 6% year over year, this is a little bit of a disappointment, I would say. This is coming in under the numbers that they have guided for. But, on the other hand, the clients have grown and the percent of clients that are heavy users has gone up. A heavy user is a client who is using, credit solutions or banking, or they have some other deeper relationship with StoneCo. So this to me is one of the stories of what's going on this quarter. Payment volume is not quite hitting the numbers that they said, but more and more clients are using banking and credit solutions. So they're shifting the strategy of the company a bit from just being a payments processor to now being more of a wider financial services offering. One of the analysts asked, given the slower growth environment we're seeing for total payment volume, how comfortable do you feel about being able to deliver the 2027 guidance? If total payment volume growth is lower in cards and Pix, can you still deliver on the guidance? And for reference, their 2027 guidance is for earnings per share to be greater than 15 reais. This would be a 27% compound annual growth rate until 2027. They're looking for gross profit to be increasing 18% annually, for total payment volume to be going up 14% annually. And that 14% total payment volume guide, they're coming in a little light here at 12%. And only 6% growth in cards, which is where the higher margins are. So that's what this analyst is looking at when they ask, can you still hit this guidance? And the answer that was given is, you're right, total payment volume is a little light. We have been gaining market share, but overall market growth has been softer than expected. It's possible total payment volume will come in a little light, but total payment volume is one dimension of a bigger plan in which we're performing really well. We continue to advance in extending our offers beyond payments to become a complete financial provider for our clients, which is highlighted by the evolution that we see this quarter in credit, in banking, and ultimately in profitability. When we think about the combination of multiple monetization drivers, cost discipline, capital allocation, including share buybacks, we're driving stronger than expected results. And we're really confident in delivering these long-term targets. So essentially, they're saying even if total payment volume is coming in a little light, we're outperforming in credit and in banking. And as far as overall profitability of the business, we're really confident with the long-term guidance. And just to quickly take a step back and look at what this guidance would mean, 15 reais per share, that's close to $3 US in earnings per share by 2027. Now, the exchange rate between the real and the dollar fluctuates a lot. It's possible that, Brazil's currency is going to depreciate against the dollar. So, this might be fewer dollars in 2027. But just for reference, there actually has been no depreciation of the Brazilian real against the US dollar over the past 5 years. From 2020 to 2024, the real gained against the dollar. In 2024, it crashed a ton. The real was down about 20% against the US dollar. And thus far, year to date, it's up, 15-ish%. So yes, there's some volatility here. There is currency risk involved in this company, but it's not like the real is depreciating, 10% a year against the dollar. In any case, even if we call this, $2.50 by 2027, the stock today is trading for $15 and change. This is a company with double-digit growth. If we just give them a 10 times multiple, that would be a $25 stock in, 2 years. And I think there's a lot of room for outperformance here too. Going back to the segment results, so that was payments that we just talked about. Banking, clients are up 23%, deposits are up even more, 36%. I mean, they've had a ton of growth here. And moving on to the credit side, this segment of the company has absolutely exploded. 25% growth in their portfolio quarter over quarter. This isn't year over year, quarter over quarter, 25% growth. Now, something I definitely want to keep an eye on is non-performing loans. Basically, loans they've given out that they might not get back. Someone's missed a payment, someone's delinquent on a payment. This jump up that we see in 90 plus day delinquencies, this is because, a year ago, they just started this division. Most of these loans weren't even out for 90 days at this point. The question is, where do these numbers stabilize to, and how do these numbers relate to the interest that they're getting on these loans? The fact that the green line, the 15 to 90 day delinquency rate here is stable and actually declining a little bit. This is a good sign. 2.5% here is actually excellent compared to what they're making on these loans. But this is definitely something to keep an eye on, non-performing loans. I want to follow these numbers, especially as their credit portfolio grows and becomes a larger and larger portion of this business. Overall, I think StoneCo is on track. They've outperformed in a number of areas. They reiterated that they are confident in these 2027 guidance numbers that they've given out. The company still looks cheap. Now, going back to our sheet, let's see what we can expect for a return on our investment in StoneCo stock today. I don't have the most up-to-date price here, so I'm just going to update this. And for clarity, when I'm working in these sheets, I'm always looking at things in terms of US dollars. I just think it's easier for me to think about stuff and to compare stuff in US dollars, but that does mean that I have to convert the local currency. This company is reporting in reais, of course, in Brazilian reais. So I have to convert that to dollars. So for example, revenue from 2021, I'm using a rough average exchange rate of the real to the US dollar for this year and converting their revenue to US dollars. This number is likely to differ a bit from the official numbers reported by the company or reported on other data sites. So I just want to put that out there that these numbers are rough. Now, as far as assumptions going forward, in my base case, I'm assuming that they grow revenue at 8% annually for the next 5 years. I think they're very likely to outperform this number here. I mean, keep in mind, right now, they're guiding for 18% growth in gross profit through 2027. But there also is some currency risk. Remember, my sheet is looking at things in terms of US dollars. So if you have the real depreciate, 5% a year against the dollar, then we should take that into account and decrease our growth rate by 5%. In any case, I think this is conservative. Free cash flow margin, it doesn't really make sense to talk about free cash flow for a company like this, a financial services company where cash is the business. As cash comes into a company like this, it goes out in the form of loans. So looking at the free cash flow number itself is often not a helpful metric, but I'm thinking about this number here as what is the excess capital that they are able to give back to us in the form of buybacks. And I think this is a fair number here, roughly 10% of revenue. And with just giving them a multiple of 6 times their operating income, I'm looking at a 21% annualized return on this company, which would be an absolutely fantastic return. My bear case, I think, is extremely pessimistic, probably too much so. I'm assuming effectively no revenue growth, margins compressing a bit, shareholder returns in the form of buybacks coming down from where they have been, and also for the multiple to compress even more to a 4 times operating income. And even in this scenario, you would be flat on your money after 5 years. Now, on the other hand, in my bull case here, I'm assuming top line continues to grow double digits. This isn't even as much as they're guiding for, but I'm taking into account a little bit of risk of currency depreciation against the dollar. I'm assuming margins maintain where they currently are. This might be a little bit optimistic. We've seen them having higher growth in some of the lower margin areas like PIX payments. But nevertheless, this is not assuming an expansion in their margins. And if I give them a 10 times multiple, which yes, this is assuming an expansion in their multiple, but I think it's probably warranted for a company like this with these metrics, then in this scenario, you're looking at a 42% annualized return over 5 years in StoneCo. This would be more than a 5x on your money today. So overall, I just think the risk reward looks really good. As far as what I'm doing, I am doing my favorite thing, which is nothing. I'm not going to sell my position. I'm just going to continue to hold. And if you're looking at this video and it's at a later point in time and the stock price is different than what it is today, you can see what your annualized return would be at different prices if the assumptions in my base case come true. So if the stock price goes up to $20 a share, you're looking at the implied return every year for 5 years of 15% in this base case. As always, this is not a recommendation for anyone to buy the stock. I'm just telling you my opinion, and I'm telling you what I'm doing with my money. If you got value out of the video, hit that subscribe button. There's a link in the description to buy me a coffee. Nothing is expected. Watching the video is honestly the best thanks. But if you want to give anything and support the videos I make here, it's greatly appreciated. If you agree or disagree with anything I said, put that down in a comment below, and I hope to see you all in another video.